All right. Thank you, everybody, for taking the time to be with us here today. We're very excited to have Pramod Sharma with us and Jivan. Pramod is actually currently an actuary at Taxivity Insurance, which he founded in 2009 and now runs with his son, Jivan. They specialize in the niche of life and health insurance with the goal of helping advisors to help their clients harness the unique protection and tax advantages of carefully constructed life insurance strategies. Earlier in his career, Pramod apprenticed to become an actuary at Metropolitan Life, developing health and life products at National Life and supporting a leading advisors at Industrial Alliance. Pramod is a fellow of the Society of Actuaries, fellow of the Canadian Institute of Actuaries, a family enterprise advisor, a member of the Conference for Life Underwriters, and a member of the Family Enterprise Exchange. He also volunteers on the board of the Western University Alumni Association and has served on other boards, including CARP Etobicoke. Feel free to ask any questions throughout this presentation, either by typing them in the chat, or you can actually speak them out loud. Now, if you'd like to type a question in the chat, there should just be a chat icon, and that'll allow you to do that. If you would like to ask your question by voice, there's a raise hand icon located at the bottom of your screen. By pressing this, it'll notify me that you would like your microphone unmuted, and I can do that so you can ask your question live on the webinar. Without further ado, I'm going to let Pramod take it away.
Thanks very much, Shelby, and thanks to everyone for attending live and to those who watch this presentation afterwards. So what we're doing in this presentation is giving you high-level information, and that means that we have simplified things. We're happy to go into more detail during the presentation or afterwards. Generally, the extra detail is most helpful when we're working on an actual case, because there we know all the specifics. So as Shelby mentioned, there are two of us. Jivan is someone who does a lot of work in the background and recently became a CFP, and then there's me. So we have several case studies that we'll be using in this session, and you are welcome to ask your questions anytime you like. And at the end of each case study, we've also got a spot for you to ask your questions. So one of the challenges is that advisors on the insurance side will come up with proposals that make unfair comparisons against alternatives. The idea being that insurance is supposed to look really good. And here's an example of that. We got a proposal from a company that you'll likely recognize through an affiliate, and he wanted to get an opinion on what was being proposed. So we took a quick look at this for him. And what you'll notice here is that they're saying in the corporation, all of the investments are in interest, and the return is 4%. So they're projecting 4% return for decades into the future and no other investments. So question arises whether that's reasonable or not. Is that really what the clients are achieving now and what they're likely to achieve in the future? Then they also call what they're currently doing the alternative investment, when it's really the current investment. Insurance is the alternative, but it just shows the insurance bias. And when you look at the insurance, there are some questions. There's $900,000 of insurance. We don't really know why. It says that they're using the current dividend scale, but they're not really saying what that is, which makes it hard to compare. They're talking about a product from Sun Life, but they're not saying what product. Jivan, how many products do they have?
In terms of the whole life, they have 3 products currently.
Yeah, so it could be any of those 3. So this isn't very good in terms of explaining things. And then it also says insurance underwriting may apply when we know that it actually will apply. You can't get insurance without underwriting. And finally, they say that this is based on standard rates. And it's good to really know someone's health up front to make sure that the rates being used are the correct ones. Then the last thing is they say that the life insurance is tax exempt, which isn't quite true. It's more tax sheltered or tax preferred or tax deferred. There's really lots of tax that's payable on insurance. First of all, there's premium tax when money goes into a policy. There is tax on the investment income that is charged to the insurance company, and they generally pass it on to the clients. There's tax if you take policy loans above the ACB of the policy, and there's tax on dispositions larger than the ACB. And finally, even a portion of the death benefit can be taxable when paid out to shareholders because the portion up to the ACB does not qualify as a tax-free capital dividend. So to say that this is tax-exempt insurance is perhaps a little misleading. Now, page 9 of the output is the one that is filled with disclaimers, and it goes on to say that there may be additional deposits required into the policy, which is not necessarily good news. But more important, it says that the document must be accompanied by insurance illustrations, but none were attached, which means it's very hard to do comparisons. If we look at the values that are shown in the product, then they look good when there's no context. But as a comparison, we looked at another product, and here we see that even though their scale is lower by about 50 basis points, the values are perhaps better or very similar, which suggests that the product being used, which isn't named, may not be the optimal solution for these clients. And we can't reproduce the calculations because there were not enough details, and we did try all 3 products, did we not?
We did, and it just so happened that none of them matched these results.
Yeah, that's a little suspicious too. We don't really know. Maybe they're using a different version of the product, or they're doing something odd, but normally you'd want that kind of detail to understand what's going on. And with this type of product, which is whole life, the results are very sensitive to assumptions, and Sun Life themselves says do not show current scale. So they have an advisor website, and there they say the dividend scale is sensitive. So they're saying show illustrations using the current scale and scale -2. Current scale -1 and current scale -2. They use those 2 scales, whether it's in-force business or whether it's new business. So what Jeevan did is some calculations showing the current scale, and the results there look fine, but you can see that if the interest rates drop by 1%, the results drop quite a bit also. And if the scale drops by 2%, you can see, which isn't that much of a drop, really, 6.25 down to 4.25, you can see that the longer term values are less than half of what they are at the current scale. Results are very sensitive. So we looked at another product, and when I say we, I mean Jeevan, because he's the one who does this analysis. And what we saw here is that the death benefit is larger by about over $200,000. And also what we saw is that when you're looking at the values, when the scale is, actually I won't move that because it seems to interfere, but if you look at scale -1, you can see that the results do not change very much. And if you look at scale -2, the results are also not as dramatically changed as they are with the Sun Life product. In fact, what you could say is that BMO at 3.75% is comparable to Sun Life at 5.25%, which is a reason why it's important to look at other options and which is more likely to be achieved, 3.75% or 5.25%. The conclusion from this case study is that it's good to be reactive as accountants and to get audits of all the insurance pitches that your clients receive. Do you have any questions about this first case? Okay, if there are questions, there'll also be an opportunity to ask them at the end, and you can also ask them afterwards too. The second case study is a different situation. This is a report from the Department of Finance where they say that saving money corporately builds more wealth than saving money personally. And that's something you would likely agree with as accountants, and this diagram just shows that same result. It's not surprising then that taxable passive income has tripled. Back in 2002, there was about $8.6 billion. And now in 2015, the latest data that they had, it's grown to about $26.8 billion. So quite a big increase that the government likes because they can tax more. And as part of their goal to tax more, they're making changes to the small business deduction. If you earn $50,000 of passive investment income, then the limit stays at $500,000, and then it just keeps dropping as you earn more. Another way to look at that is that if you earn lousy returns inside your corporation, say 1%, then you can shelter 5 million in your corporation. But if you earn returns like say 5%, that drops to $1 million and it keeps going down. So not very attractive for corporate clients. Our situation is even worse because the situation is $2 million of retained earnings and the returns on them are 8%. So that would cause issues. What this means is that there's $160,000 of passive investment income each year. After then, the amount of tax paid is a little more than half, which means that after doing taking all the risk, doing all the investing, the client earns less than half of the corporate income after tax. So in terms of goals, what these clients wanted to do is pay less tax. They wanted to save for early retirement. In their case, that means 15 years away. And it was very important to the husband to make sure that the income is secure for his wife because women generally live longer. And in his case, he's concerned that he may pass away even earlier based on family history. So he wants to make sure his wife is fine. As a husband also has term insurance and permanent life insurance in place so that he's protecting his family. So he understands insurance. Another goal, the third goal, is to leave an inheritance for the children. So very good goals, and maybe some money for the grandchildren too. So are these goals unusual? Probably not. A lot of people would have these sorts of goals. But the sad part is that the accountant in this case provided no proactive advice to the client to help achieve these goals. There is a complication, health issues. The wife is a female non-smoker, age 39 in good health, so no issues there. The husband is a male non-smoker, age 46, and he has mild diabetes. That means his mortality rates are 50% higher than standard. That makes his insurance age not 46, but 50. And how do we know that? Because we have Jeevan. So what do you do when we're working on a case?
So in cases like this, or really in any case, we always ask a client, do they have any medical conditions? Have they had any major medical events with things like a stroke, or have they been in a car accident that resulted in some sort of trauma to their skull? That sort of information. And based on the medications they're taking, the medical event or condition they have, how long they've had it, have they had any changes? There's a whole slew of questions that insurers like to ask to be able to make this assessment. So we gather that information and we anonymously send it to various insurers, and then we see what their responses are. And based on that, we know which insurer is probably the best one to go with in terms of getting the best outcome for the client.
Yeah, so that it does take several elapsed days to get that information, but we're able to give more realistic results to you and your clients by taking those extra steps. So if you look at the actuarial math, a 46-year-old with a rating combined with a female non-smoker gives a male non-smoker age 34 when you're looking at joint last to die. So what this is saying is that age and poor health have limited impact when you're using joint last to die insurance, which is the form we use as often as possible for tax planning purposes. So here's the strategy that the accountant overlooked. It's called front-end investment leveraging using corporately owned life insurance. The product used here would be optimized to have high early cash values. The trade-off is that the cash values in later years are lower. And here's a diagram explaining how this works. So what we do is transfer $1 million into joint last to die life insurance. The transfer speed is 10 years, so $100,000 a year. So why don't we do this faster? And why don't we do this faster? The reason is that the tax rules for insurance changed on January 1st, 2017, and that prevents deposits from taking place over a much shorter period. So we put the money in as fast as we can. The next thing is we look at a design, and here we picked a life pay design rather than a guaranteed 10 pay. Why? The reason is that there are additional tax advantages when premiums are payable for life. And we wanted, in this case, the client wanted to get all the tax advantages And so we use this choice for them. Another item is that we use a product which is hybrid life. You may be familiar with whole life insurance and universal life insurance. There's an additional category called hybrid life insurance, which combines the advantages of each of those categories. We picked this because it allows larger loans, and there are special lending terms with this particular product. Also, it's optimized to have high early cash values. To make this work, the face amount is $2,211,349. Jeevan, why that specific number?
Well, in this particular sort of strategy, the insurer themselves calculates everything for the front-end leveraging. It's actually so specialized that advisors are not allowed to do it on their own. So as a part of that process, they look at the amount that the client wants to put into the policy, and they try to, or they do calculate the minimum amount of insurance the client needs to be able to shelter that amount of deposit under the current tax rules. So that's how we have such a specific number there.
Yes.
And in other cases, we can also calculate that ourselves.
Right. So life insurance, there are charges that come out of the product, but you also get tax-sheltered compound investment growth. That means your collateral for the loans is growing each year. That means that more money can be borrowed each year, which is attractive. The idea here is that you transfer the policy to the lender as collateral as soon as the first transfer is made. Then a loan is taken, and that goes into qualified investments. In this case, it's mortgage loans earning 8% that are being used. The bank wants loan interest paid on a regular basis, so that goes to the bank. But because of this strategy, the borrowing is being done to invest in suitable investments, there are tax deductions on the loan interest. In addition, there are tax deductions on a portion of the premiums. And that's because the lender requires insurance as a condition of the loan. That's a reason for having a life pay design, because the premiums are payable for life, and that means that the deductions can also take place for life. Now, when we look at numbers, because I know you're accountants, you like numbers, here's what you see. And this is, again, based on what this client wanted. $100,000 goes into the insurance policy, and $100,000 is borrowed. There is 5% loan interest based on the assumptions used in this case, so that's $5,000. And then there's a specific amount of income required to use the tax deductions. The amount of income grows every year, so there's net interest paid, and then after the interest is paid, that same amount is borrowed back. The result is that there is a net cash flow of zero each year. You can see that the deductions are increasing. So when you look at the graph, you can see that they can get quite large. That's why your expertise is essential to help the clients figure out the magnitude of deductions. So for example, if you decided that the deductions needed to be, say, $100,000, then at some point you would say, let's stop having the loan grow and let's start paying the interest rather than having the loan get larger every year. In terms of more numbers, when you put in $100,000, the cash value of the policy is not $100,000 because there are insurance charges, etc. So the cash value is actually $75,000. When the client is borrowing back $100,000, it means that they need to pledge additional collateral so that the bank will lend the $100,000 to them. Then there's a death benefit that keeps growing and growing. There's a capital dividend account, and we'll look into that in a little more detail. You've got the loan balance that keeps growing. You can see with the additional collateral, it grows for a while and then eventually becomes zero. Throughout, there's a net cash flow of zero. And there are some proceeds that go to the estate. The next slide shows that a little more detail that may be easier to understand.
And one thing to note is that in this case, the client was comfortable with posting additional collateral, but some clients are not. And in those cases, there are strategies in which no additional collateral is required. And typically there, we're looking at borrowing 90% of the cash value instead of the full amount of the premium paid in that year. So there's a little bit of flexibility there.
Yeah, thanks for that, Jeevan. That's important to point out. So what's going on with the policy? You've got the death benefit and you've got the loan, and then there's a net amount payable to the corporation. So for example, if both people passed away in year 15, the death benefit of the policy is roughly $5 million. The loan at that point is about $1.5 million. So that means that the corporation receives about $3.4 million. There's a CDA credit of the death benefit minus the adjusted cost basis. So that works out to be about $3.8 million. And there's an unused excess CDA credit also provided. And there are tax savings on that. Again, we can go into a lot more details of this because this is just meant to be a high-level webinar. When we're looking at a specific case, the numbers will probably make more sense. Is there anything you wanted to add, Jeevan?
That sounds very good.
Okay. So there was a complication in this situation, and that was qualifying for the bank loans. The clients here are comfortable with investment leveraging. They've built wealth using that strategy. They're also comfortable with life insurance. They have various policies in place already. But they're not sure that they'll qualify for the bank loans because of the nature of the businesses that they have, because they have multiple businesses. So what happened here is that we moved to their second goal, which is retirement income. What this means is that discussions will often start with insured investment leveraging. That's something that has a high level of appeal to people, but they'll often lead to a different strategy, and that's fine too. So the conclusion from this case study is that you don't want to be inactive, as the accountant in this case was. It's good to help your clients get insurance for opportunity when they don't specifically need it for pure protection. Are there any questions that anyone would like to ask at this moment?
We had one question that actually came in earlier
Sure.
via the chat. Who provides audits? Is it you? And what's the commitment on a client's part? I.e., is there a fee?
Yeah, so Jeevan and I are the one who do the insurance audits. There is no charge for it. It's just part of the services that we provide to wealth stewards and affiliates. So please feel free to try us out.
Excellent.
Okay, and if there are other questions later, then feel free to ask them also through the chat or however you want to. So we're done with that case study. The next one is a different one. Each of these is different. Here the goal is to supplement retirement income. We're still working with the same couple that we were just looking at on the corporate leveraging strategy. So here the idea is to put money into a life insurance policy, then assign the policy as collateral to the lender at the time of retirement. Here, no additional collateral is required, which means it's easier to qualify. The only collateral is the insurance policy itself. Then at retirement, the clients can take tax-free income via loans. Essentially, they have a line of credit that they can use as they wish. What's good about this in comparison with RRSPs and IPPs is that there's no requirement to take taxable income if it isn't needed. Because clients, say in this particular case, also want to leave money for their children. So if they take smaller loans, then that means that there's a larger tax-free estate value for their children. So that's a positive. What happens here is that unlike the previous strategy, there's no requirement to pay the loan interest on an ongoing basis. The loan interest can compound, it just gets added, the loan interest gets added to the loan balance. And ultimately what happens is the tax-free death benefit repays the loan, and whatever is left then goes to the heirs. So this is a pretty clean strategy. So as I mentioned earlier, many people will talk about insured leveraging strategies for investing, and they'll decide that this is really what they want instead. Question: corporate ownership or personal ownership? In this case, the clients decided on personal ownership, and there are several reasons for this. First of all, you can get creditor protection with personal ownership because the beneficiaries in this case are in the preferred class of spouse, parent, child, and grandchild. In a corporate context, you would normally hold insurance in a holding company to provide some creditor protection, but it's not as strong as this creditor protection that's available on the personal side. Also, they're intending to close the corporation at retirement. Having insurance in that entity long-term wouldn't necessarily be the best approach. Personal is simpler because the husband wants to make sure that things can be maintained after he passes away for his wife. And also, there's no possibility of guarantee fees. When you are using this strategy and you're funding it with corporate money and you're taking loans personally, there may be a guarantee fee required for the shareholder to pay the corporation because they're using a corporate asset for personal benefit. Here, when everything is personal, the guarantee fees do not apply. And finally, personal funds are available. This family has multiple businesses and they are receiving taxable income and they have savings built up that could go into the insurance. Here's what the design looks like. We're using joint last to die. The reason for that is it lowers the insurance charges, which means that there is more tax-sheltered investment growth. We're using a guaranteed 10 pay. There's no reason to use a life pay in this situation. This also eliminates funding surprises. The way these work is after 10 premiums, there are no additional premiums ever required to keep the policy going. So that provides good peace of mind. There are also guaranteed cash values in the product, which are also good for peace of mind. Here, the cash values are optimized for retirement income. That means that they are lower in the early years and higher in the later years. So basically the opposite of what we had in the previous strategy. So when clients have multiple goals, they have compromises because a product can't be designed for high early cash values and high later cash values. How much life insurance? Well, the goal here is they wanted to have $120,000 a year of income after tax. And that meant Jeevan calculated the deposits and the face amount to achieve those goals. Now, it looks like we're doing things backwards. Normally, you'd start with a need for insurance and figure out how much can go into the policy, et cetera. But even with this approach, which is widely used in the field, the client has to qualify for the insurance. So it's not that you can just say, here's how much money I want to use, get me insurance. They do have to qualify. There are unknowns, and that's why we show sensitivities. We don't know when the client will actually retire. They tell us they plan to retire at a certain age, but that doesn't mean they actually will. We don't know when the second person will have passed away. Now, in what we show you on the following slides, we would normally do illustrations at current scale minus 1 or 2%, but the tools that were provided for this situation mean that we have to use the current scale, but clients do receive CLHIA compliant projections. That's the Canadian Life and Health Insurance Association. Insurance companies are required to provide a certain amount of disclosure, and generally the illustrations run how long, Jeevan?
I think our most recent case was 112 pages.
Yes, there's a lot of detail available to show sensitivities. So Jeevan, you spent a lot of time calculating these things. You want to walk us through this?
Sure. So as is logical, the sooner that the clients want to draw income and the longer they want to draw it as well, the more money they have to put in today to be able to achieve that goal. Now we use ages 90 and 100 to be conservative and to show the maximum length that they're likely to need the income. So we looked at ages 60, 65, and 70 as start ages, and the income lasting to ages 90 or 100. So we can see that the income need for having it come from, say, 60 to 100 it requires quite a large deposit. However, despite that, we see that they put in $2.1 million. They do get quite a bit of income as a result, so $4.8 million, resulting in a net increase over their deposit based on the income of $2.7 million. And that equates to a IRR on that cash flow of 2.4%, and a external investment would have to earn about 4.9% before tax to compare to that result. And we can see across the board results follow a trend of the sooner you wait to start, the less you have to put in, and the sooner the income ends, the less you have to put in. So that's essentially how that functions.
Yeah, so the clients came and said that, okay, I want to retire at 60. We could have just done, and I only want the income to age 90. Actually, he wanted it for even less time. And we could have just done that run, and then we would have been completely finished. But then clients want other things, and so it even takes extra time to come up with these extra options so that when sitting down with the client, we can show them different trade-offs. So you can see that if you defer retirement, then you are able to put in less money, right? So for example, defer retirement to age 70, have income to age 100, you need 116,000 a year of deposits rather than 210,000. So this table, we think, will help you and your clients see the sensitivities and make better decisions. Then there's also the issue of repaying the loan at death. So Jeevan, what's going on here?
So here we're looking at a comparison of how much the client has put in and how much their beneficiaries will get if they were both to pass away. Now, just to make matters manageable, we're assuming that the husband and wife pass away in the same year that the husband turns the shown ages, so 85, 90, 95, and 100. And we can see that even after paying off the loan, even at age 100, after they've been drawing for quite a while, there is a pretty significant death benefit there for their beneficiaries, which would, perhaps help their children buy a new home. Some of that could go to a charitable cause. There's a lot of things that could be done with this money, and despite having so much left over, they were still able to, or will still be able to augment their retirement with the strategy provided.
Because that was their third goal. They wanted to be able to leave money for their children and possibly grandchildren. And we can see with this strategy that's certainly possible. If they took less income because they decide on the amount they want to take, it doesn't have to be level, there would be even more for their children. So in conclusion, for this case, we can see that corporate ownership isn't always the ideal solution for people who have businesses. In this case, personal works a lot better. Are there any questions that people have at this moment? Okay, hearing none, we will move on to the last case study. Now, this one may seem like a very simple case, and in a way it is, but in a way it isn't either. So the background here is that the business owner is a 63-year-old male non-smoker, currently has $5 million of term 10. The premium is $13,400, and this year it's going to be increasing to $94,200. Quite a shocking increase, so something needs to be done. There's a corporate need of key person insurance of $2.5 million, so no longer a need for $5 million, but $2.5 million. And so the accountant in this case was very proactive. So 2 years before the renewal, so back in 2017, the accountant explored different insurance options, looking at term 10, term 15, term 20, and also laddering, which means having a portion of term 10, a portion of term 20, etc. And then last year, he revisited the insurance. And what we did is we compared the maximum conversion ages from credible insurers. And we saw that for cheaper products, the maximum conversion is age 70, which is only 7 years. A conversion means that you can switch from the term insurance to permanent life insurance regardless of health. With products that charge more, the maximum conversion age is age 75, which is 12 years. So in this case, the accountant's recommendation was to get term 10 from a credible company, and each company differs in their reputations for keeping promises, paying claims, etc. So the credible company is important. He also wanted to have the longest conversion period, which means to age 75, and not just have a conversion option available, but also to pick a company that has good products available for conversion. So this accountant understood insurance quite well and identified some key factors to consider. So in this table, it shows the current term 10. The premiums are $13,400. They go to $94,200. And if you keep the insurance longer, they become even more crazy. If the client bought term 20, then there's a certain premium. You could also get term 15. But what was done here in this case was term 10. So the premiums are very good for the first 10 years. If the client's health has deteriorated, then the renewal premiums will jump to $116,550, which is still good compared with what they would have been over here. But if the client needs insurance after 10 years, the plan is to apply for new insurance. And based on what rates are for a 73-year-old today, the premium would be about $63,000. So they're not expecting a need for insurance beyond 10 years, but this accountant wanted to make sure that different contingencies were considered so that there would be no surprises. So in this case, the accountant did wonderful work, took time to explore options for his client well in advance, and he picked the longest conversion period, even though this did cost more. The client doesn't see a need for permanent insurance, but he still agreed with the accountant's recommendation, which is a sign of trust. And having a longer conversion period is a way to reduce liability, because suppose the client views change and the client's now 72, they want permanent insurance, but they don't qualify because their health is deteriorated. How happy would they be to find out they could have had a conversion option to age 75, but they got a cheaper product that only had a conversion to age 70? May not be very happy in that case. Also, the accountant overcame the client's procrastination, because the client, and in this case and other cases, typically wants to wait until renewal is soon. So if renewal's 2 or 3 months away, then okay, let's start looking at insurance. But in this case, the accountant got the process started much earlier, and the accountant also stayed involved in the process, because if the accountant had not stayed involved, then the client would have procrastinated and very little would have actually gotten done. So the handoff took place when the application was submitted, and that's where we followed the whole process all the way through. So in this case, there were actually a bunch of complications that occurred. Term 10 insurance looks like something really simple, but in this case, it turned out there were various delays. This client does not have a personal doctor. He uses a clinic, and they provide different levels of service than a family doctor would. So the clinic was quite slow in passing on information to the insurance company. And as a result, there were some questions the insurance company had, and the underwriter declined the coverage. So you can imagine how the client feels. The client feels he's very healthy and gets a response that the coverage has been declined. Normally, the underwriter would notify us, but underwriting has changed over time. It's become very rules-based, and there's not as much gray allowed anymore, because there are quotas on underwriters, and if they can get files off their desk, then that's a good thing. So what happened is the client got declined, and then we talked to the client, and after a period of steps, we were able to get that client approved at standard rates from that very same insurance company. So that's an example of being persistent and getting some results. Not every case is like that, but this case started back in June. The policy is going to be delivered in mid-February. So you can see a lot of time has taken place in this case. If the client had waited until 2 or 3 months before renewal, then the client would have been paying much higher premiums until the insurance was approved. Now, this client is health conscious and has an interesting product which you may not be aware of, but which can be very valuable. We call it queue jumping insurance. So what this lets clients do, and this is attractive to executives, is jump the queues in Canada that are caused by medical delays. So they can get quick second opinions from leading US hospitals. If they need treatment, then they can get funded treatment in the US. So what we're looking at here is the plan that the client currently has. And there's also concierge service, because this is a traumatic time, to make sure all these things work out well. So what we're proposing is an upgraded version of this product that has higher limits and includes business class flights. But we are not going to propose that until the life insurance is in place, because it's not good to have too many things going on at one time. And life insurance is the easiest product to qualify for. So we wanted to make sure that was done before getting into improving the health insurance. The conclusion here is that it's good to be proactive the way this accountant was, because implementing insurance takes time and care. Are there any questions about this case, or are there any questions in general for this webinar? Okay, so you can certainly ask your questions afterwards. Our contact information is easy to get a hold of, and we'd be happy to help you further. Just as a wrap up, if you're looking at things from your viewpoint of having opportunities, you have quite a few when it comes to insurance. So do you have any healthy clients who are under age 65? They may be interested in getting unlimited drug coverage or long-term care insurance. Do you have clients who are intending to travel outside of Canada when they're in their 70s? Instead of getting travel insurance each time they go on a trip, they can get travel insurance with full medical underwriting based on their age today and their health today. They pay a level premium. So that can be good for people who want to be able to travel in their 70s, whether they're in their 60s now, 30s, 40s, whatever. And again, pre-existing conditions cause trouble. So with insurance, it's good to get it soon. Do you have clients with children in university? Disability insurance is a really good choice for them. They may be able to get discounts and simplified underwriting because they're university students. There's special advantages depending on the program. So the best opportunities are for medical students and also engineering students. Do you have clients who have adult children? Maybe health insurance would be good. And again, if they're young enough, under 65, they can have a relatively inexpensive add-on that provides unlimited drug coverage. Disability insurance is also important, critical illness insurance. So if you have healthy clients, then there are lots of things they can do. And if you have clients who demand the best medical care, then the queue jumping insurance we looked at a few slides ago might be something that they would want to consider. And you might find that you are in these categories and might want to look at some coverage for yourself. So life and health insurance combines protection and tax advantages. There's lots that can be done. There's only so much we can cover in a webinar. The best results are when we're looking at an actual case, because then everything is real and we can show you the options that meet your goals prior to your client seeing anything. So please feel free to ask us anything, anytime. Our webinar is, like, our part is done, so we're going to pass it back to Shelby. And thank you for watching. Okay, Shelby, thanks.
Thank you.
Thank you. Thank you very much, Pramod and Jeevan. If there are no other questions, then that does bring us to the end of the webinar. Thanks so much to everybody who's joined us. We'll be sending out PD certificates to those who are online. And as well, a recording of this webinar and the slide deck will be sent out in the next couple days to all participants. Our next webinar is going to be on February 27th. So if you're interested in attending that, please save the date. We'll be sending out more information about that as we get closer to the time. Thank you so much, Pramod and Jeevan, for your time.
Our pleasure.
Really appreciate having you here. Have a great day to everybody. Thanks so much.